morning and welcome. My name's James Smith. Thank you for joining us this morning for our third quarter update on our outlook on views and strategy. I'm here this morning with Grant Patterson. Grant, good morning.
Good morning, James.
We've started this year with a view that this was a year of change. Could you just update us on how we're seeing that playing out over the first half of this year?
James, yes, we have started to see some changes in policy. The central banks around the globe are starting to indicate that they're going to move from quant easing to quant tightening. We've seen rising bond yields, particularly in the US. There's a potential pickup we see in inflation, which we haven't seen for some time, and strong wages growth in the US. And now we've got thrown into the mixed increased trade tensions instigated by President Trump and the United States.
And with regards to that cautious stance that we've been articulating over the course of this year, are there particular points that we're really focused on in terms of signals that we're looking for and what's really concerning us in particular?
Well, certainly inflation and wage growth in the US is a key for us. I mean, you've got record unemployment in the United States, down around 3.5%. And we're starting to see some pickup in wage expectations. A great example is in the trucking industry, where we've seen very, very strong wage push come through, and that will lead through to higher inflation, plus the higher oil price that we've seen coming through the economy.
And despite these concerns that are starting to filter through, the markets seem to be incredibly complacent, and we actually saw markets recover during the second quarter of the year. Why do you think that's the case? Well,
James, look, it's very easy to get cautious after a very, very long cycle. We've had a great decade after the lows of the GFC. And so I think investors have become a little bit complacent in regards to the markets. I mean, there is some good news out there. The US economy is growing very strongly at about 4%. That's underpinning corporate earnings growth that was up 20% during the quarter. You've got a banking sector around the globe that is much better shape than it was in 2007. So there is some good news out there, but there is more and more concern starting to build into the system, and we're quite concerned about a number of issues that are starting to filter through, and that being rising interest rates. There's still record global debt, so any rise in the long-term rate is going to have an impact in regards to that debt. And we are late cycle, valuations are stretched in our view, and therefore we think there is time for some caution in these markets. Although at the moment, as you say, markets are and investors are very complacent, we feel.
And if we talk about valuations specifically, how are valuations sitting versus sort of long-term averages, just to give people a bit of a guide as to where they're sitting at this point in time, given all of those points you've made?
Well, if we're talking about equities, I mean, because of the strong corporate earnings growth that we've seen through better global growth, forward earnings are around about their 20-year average, so they're not really stretched. But if you look at where we are with margins, we're at record margins in the United States, and on a cyclically adjusted PE basis, which is called the Shiller PE, and we're up around record highs at 30 times in the US, so that is a concern to us.
Yeah, and that brings back that question as to why the markets are so complacent. Let's touch on tariff, or the looming tariff wars, if we can call it that. How do you see that being reflected in markets, and perhaps in particular around emerging markets and China in particular?
Well, we've started to see some impact, particularly in emerging market bonds, which have sold off quite aggressively. And the Chinese stock market, whether that's a canary in the coal mine or not, I don't know. But from top to bottom, from its recent high anyway, it's down around about 20%. So there's real concerns in Asia in regards to the impact of the trade tensions. I mean, no one wins a trade war, and that's a concern. It is inflationary, and it can undermine business confidence. So we think the markets are really dismissing the potential impact of these trade tensions if they move towards a full-out trade war.
And with regards to property, looking at housing in Australia, there's this constant concern that we have about debt obligations and so on. Could you just really update us on how we're seeing property values and observations?
Yeah, well, going back to your point before about valuations, I mean, we've had interest rates and bond rates decline for the last decade. Well, in fact, for the last 30 years, we've had bonds declining in yield, and that makes property yields much more attractive. But if you've got a bond yield that's now no longer 1.5%, but is closer to 3%, then cap rates in property aren't as attractive as what they used to be at that sort of level. Within Australia, we've been articulating for some time that we are concerned about the record housing debt levels and the household debt levels, and we've started to see a pullback, evidence of a pullback in the residential property markets, with Sydney down, Sydney down about 4.5% over the last 12 months, and Melbourne down not too far dissimilar. So we are concerned there. We are seeing some price action on the downside. The other thing that concerns us too is that the funding costs for the Australian banks is going up, and that's going to have to be passed on to the household sector. So we still think that there's further downside in that market, and we're still quite cautious.
Yeah, and recent inflation data in Australia really puts the RBA in a bit of a bind, because inflation is at the bottom end, if not below the bottom end of their range. There's been quite a bit of commentary and press in the last couple of weeks about super fund returns and longer term returns. Do you want to make some observations about that?
Yes, well, this is all coming out of the Royal Commission that is still going on, and they're having a look at the returns out of certain super funds. I mean, there's no doubt that the retail super funds, particularly the bank-sponsored retail super funds, have underperformed the industry funds, and that's largely due to a higher fee structure that they have at a retail level. We're quite pleased that over the last decade, when we're comparing what's been published in the press and what our portfolio has done, the Providence balanced portfolio is up in the top 10 returns of super returns, which we're quite proud of. You know, we continue to believe, as we have for the last 18 years, that independent, non-conflicted advice is what aligns us in the best interests of our clients.
So with some of those thoughts and observations, how are portfolios positioned accordingly?
Well, we're still concerned in regards to the overall, you know, risks in the global economy. We have record levels of global debt, and that hasn't changed. We're starting to see the unwinding of the central bank policy and higher bond rates, and we're now starting to see the trade tensions. So for us, we think that there's going to be some shocks or some, you know, a bit more volatility during this year. Yet markets can continue on a lot longer than you expect. So we think the most important thing, we are, if you like, investing for a correction. We're ensuring that we've got fund managers that have shown previously to perform well in down markets. We don't have our offshore risk assets hedged back into Australian dollars, because if there's a correction overseas, we feel that the Australian dollar will weaken and therefore protect the portfolios. So what we're doing is that we're ensuring that we've got a high level buffer of cash, currently running on average around 20%. We're making sure that we've got strong diversification across all the asset classes, and we're looking for non-correlated assets that will protect us in a downturn in equity markets.
And if there was one or two particular signals that we would be watching in terms of all of the risks and observations that you've outlined already in our conversation, what would they be if there was one or two?
Well, one thing that we have been focused on and the market is starting to focus on is what's called the yield curve, the difference between the long end of the bond yields and the short end. That started to narrow. That's usually been a very good predictor or precursor for a slowdown in the economies. So we're watching that as that narrows further and further. And we're also looking at any uptick in the inflation rate that might see bond rates above the 3% in the US that the market's looking for. And in fact, we would not rule out the potential for bond rates in the US to head towards 4%, which we think would put a real buffer or a real caution on risk assets and valuations.
Thanks, Grant. And are there any other updates with regards to Providence you'd like to share?
Yes, there's been quite a bit going on. We're delighted to announce that Pretty is going to join us full time here in the office, so that's wonderful. We've seen some pretty good returns starting to come out of the direct property exposures that we've had for clients that we deployed about 4 or 5 years ago that are starting to be realised. The agricultural fund that we've been working on for about 4 years with growth farms is about to be launched, and we're quite excited about that. And also we've been running, or you've been running, in fact, the young adult series. I know you just had an evening down in Melbourne last night, and we'll be rolling that out in Sydney, and that's gained a lot of interest from the young adults of our clients.
Thank you very much, Grant. Thank you for joining us, and we'll look forward to updating you in 3 months' time for our next quarterly update. Thanks for watching.